I think, there's a big debate out on how damaging tariffs are to the global economy and how they impact locally. And, we're emerging markets investors. We've been following Argentina for many years, which is a country that has very high tariffs, very protectionist market, and it's been a total disaster for the economy. So we're kind of skeptical of tariffs overall. But it's true that when you set up roadblocks to global trade, it also creates opportunities for certain companies domestically, and it's very unpredictable at the moment. So we're all waiting with bated breath until April, until we see the reveal of these reciprocal tariffs that Scott Bessent obviously has been talking about here and that have been pre-announced. What's missing is the detail. And the detail is all that matters in the end. And we've seen, of course, that a lot of tariff policy seems to be made a little bit on the hoof, rolled out, rolled back, rolled out again. So, as an investor, I don't think you should be placing big bets on where tariffs will apply and who the big winners or losers are. I think you've got to be diversified. And in a way, I think that's what we're seeing in the markets is people are diversifying away from their current overweights in the US market. There is money shifting to Europe, to Asia, because paradoxically, although those are the targets of the new tariffs, we just don't know how things will play out.
And yet the US is still the world's largest economy. So if these tariffs end up tipping the US economy as collateral damage into recession, that's going to be terrible, isn't it, for growth assets and risk assets?
Yeah, so look, the old saying, which I think remains true, is that when the US sneezes, the rest of the world catches a cold. And the US has really been an engine of the global economy since the Second World War. Obviously, we've had higher growth rates elsewhere, in places like China, but these have been linked to US domestic demand as well. So decoupling the US, which, as you said, is the world's largest economy, is going to be painful in some ways. And certainly if you engineer a slowdown in the US because you end up with inflation, you end up with various other issues, is going to be a net negative. But at the same time, we have to look, switching to equity markets and away from GDP growth, we have to look at how people are positioned. We have to look at valuations. And the point is that if growth slows down everywhere, you're probably better off being in companies that are cheap in places like China and potentially in Europe. Valuations are already low and actually reflect weak earnings. In the US, that's simply not the case. So if you end up with a lot of these momentum-driven companies reporting disappointing growth figures, you will suffer a lot more. So it's a relative game as much as an absolute game. But I agree. I think that still holds. If the US sneezes, the rest of the world will catch a cold.